Is it possible to avoid paying capital gains? And is it legal? Well, the answer is yes, you can legally avoid paying capital gains, but you have to have the right strategies. Today, I'm joined by Geoff Sokol, my fellow Growthinker and resident wealth advisor for Growthink Registered Investment Advisory. Geoff, welcome to the show.
Thanks, Tim. Good to be back on.
So let's start this thing off with what are capital gains and why should we seek to avoid paying capital gains at all costs?
Well, this point is very near and dear to my heart. The clientele that we work with, asset protection becomes toward the top of the list, if not number one, then certainly in the top two or three, even more so than performance, because when you start to be quite wealthy, it's the impact of losing money is more significant than how much you might be able to make. So asset protection is a big one for us. We do that there's complex structuring you can do with your entities. You can move from, say, California to Texas. There's all sorts of different things you can do. But one thing everyone can do, no matter where you are in the world, is use different strategies to shelter your revenues and your assets from taxation. It's all legal. I know that we're going to use a title here about how to avoid it legally, and it'll attract some more people to come and watch. But this is all legal. I should highlight that. It's just really a matter of if you know how to do it, then you absolutely should be doing it, but not a lot of people know how to do it.
There's a case to be made that the ultra high net worth get that way because they know how to have the system work towards their benefit, not avoid things or do things, be in the shadows, is they just know more or less and they have better strategies and they know how to employ those strategies to keep more of what they make.
Exactly. Even if they don't know how to do it, they have enough money that they can afford to structure something like they can have a family office. Then they can even put accountants or legal advisors on the payroll, or they can double and a role at one of their companies, as well as supporting their family in serving multiple functions. So it's just a matter of, leaving no stone unturned. And if you can afford to do it, then the cost dramatically outweighs the downside.
Yeah. So what are some practical examples where someone may pay capital gains just for maybe the entry level person listening to this and they're starting to think about capital gains? They know they may be affected by it in the future, but what would be some practical examples?
The capital gains tax itself is broken down into long term and short term. Long term is if you've held something for more than 365 days. Generally, it's better to do that because the tax rate is more favorable. You'll pay something like an income tax rate or your effective marginal rate, as opposed to a short term capital gain, which typically is going to be as much as 30 or 40%. And don't quote me on that, by the way. I should say, consult a professional, work with an advisory group, work with an accountant. None of these things are set in stone, and there's no one size fits all solution. But back to the question, a capital gain. So the easiest way to think about it is, let's say it's the middle of October 2024 here. Let's say I look at the stock market, it's toward all-time highs, and I want to get in there. So I put a few $1,000s in the S&P 500. Let's say it's December of next year and it's gone up 10 or 20%. I decide to sell. I want to buy some holiday presents or some Christmas gifts, whatever it is. That would be a long-term capital gain, taxed at my effective ordinary income rate. And that couple $1,000 having appreciated 10 or 20%, that is my capital gain. That is the amount on which I am paying the taxation, which would occur in that year, which I should do by April of the following year.
Right. So if you magnify that, let's say 100-fold, and you have a business that you've been stacking investments in as well, you have real estate that has been growing, you have a portfolio that's been growing, and you're thinking about retirement and you want to start cashing out, those capital gains are going to be significant, correct?
Absolutely. So significant to the point that what I come across very often is they just don't want to create what's called a taxable event. So they never make any transactions. And then it's like a situation of damned if you do, damned if you don't.
Right.
They don't want to pay the taxes so badly that they never transact. And then 10 years later, things appreciate in value. So now the taxable event gets larger and larger and larger. So what's really important to do is come up with a plan and figure out strategically, when does it make sense to realize your gains? How can you offset those gains with some capital losses or qualified business expenses or accelerated depreciation or whatever it may be? Then you can realize the gain, minimize your tax liability, and never come to this fork in the road where it's been 30 years, you want to cash out, but the thought of paying the tax man is making you sick to your stomach. So you just end up sort of in this doom loop where you don't know what to do.
Yeah, in many cases, I think it's we use the term sometimes salacious. I'm sure there's a better term, but to say, hey, zero capital gains. A
Hmm.
lot of folks don't end up at zero. I mean, there's plenty of smart individuals out there, but if you can end up at 3, 5%, maybe 10%, that's a big spread from 30%, 40%, right?
Yes, it's a magnificent spread. So worth seeking. Um, I should say also this 0% rate, it is possible, not for all of your money, but there are investment vehicles such as a Roth IRA account where the money goes in after tax, it grows on a tax deferred basis, and after age 59 and a half, it comes out tax free. So to the extent that you can put money into a Roth, I say it's low hanging fruit. You absolutely should do it. You can put in $7,000 every year, 8,000 once you get into your 50s. So that's something that everybody should do. There's also the ability to do what's called a backdoor Roth conversion, because what some high net worth business owners or just high net worth, W-2 salary employees do, they Google it. Oh, I'm above, my household's making more than 240, $250,000 this year. I'm above the contribution limit. So then it's out of sight, out of mind. But if you're above the contribution limit, you can still put money away in other investment vehicles. And then in the following year, there's what's called a Roth conversion. So you can still get that money into the Roth that is never going to be taxed again from that point forward, as long as you wait until age 59 and a half. So these are things that everybody can be doing and certainly should be doing as long as they file with the IRS. There's a Form 8606 for a Roth conversion, some technical stuff to be aware of. If you can pay 0% taxes, it's just one of these things I lay awake at night wondering, why don't more people do this?
Yeah, that's a great question. We talk a lot about the entrepreneur, the business owner that is constantly scrambling with cash. And it's more of like an emotional cash scramble than it is a logical one because, especially if you've been in business 10, 15, 20 years, which many of our clients have, they don't need to have that mental scramble. It's just they remember the early days when things were lean and they like to have big reserves. Are there things that they could be doing with those reserves that give them a little more liquidity and access, but maybe still help them with a tax advantage?
Having some money around is, obviously anytime you have an emergency fund or a solid cash balance, it's something to fall back on. If the need comes up, you never want to be in that scramble. I would say what this goes back to is planning. For example, most of the clients, I'm very friendly with their accountants. We're meeting probably at, almost every month or at least every couple of months. And during those meetings, we're going to be doing some tax planning. So we can forecast out how much revenue we expect this year, how much expense. We can go line by line and figure out what deductions we have. And we can actually pay the IRS. We do it probably 3 or 4 times every year instead of waiting 12 months. And then it's a little bit of guesswork. Like, okay, we made a lot of money. I don't want to get in trouble. Let's just pay it. How much is it? Oh, that's more than I thought it was going to be. I don't have that much money. And that's how you end up in that type of scramble. Whereas if you're proactive, if you're having meetings, if you're going through it, if you're making your financial projections, then you can pay every 3 months. And logically, that's a smaller amount of cash needed to do it, and it's easier to plan for. So having a plan is really the best way to go.
Well, yes, and to add to that, you made a good point about having a plan, but also having smart people in your corner. So you have your wealth advisor, you have your CPA or your accountant. Probably if you have business partners, enroll them in the conversation as well. You're definitely going to want to enroll your stakeholders, anyone that like a spouse or anyone that's affected by this as well. What else comes to mind with that?
The the Roth we mentioned before, part of what may happen is I say that number of $7,000 or $8,000 that you can put in, it might just not be an enticing enough number to where people really think, oh, well, I've got this $1 million business. I can't wait to put away 7,000. It just
Right.
Doesn't pack
Right.
that much of a punch. So I should mention there are retirement vehicles like a SEP IRA, which is a self-employed plan. There's a solo 401k, like for a solo entrepreneur who represents and works for himself or herself. These types of plans, there are others, but those are the ones that come to mind for my demographic at least, where your contribution limit is up to 66,000. That packs a little bit more of a punch.
Sure.
Then
Absolutely.
in the next year, you can start doing your Roth conversions with that amount of money to ultimately get to that 0% tax rate. So there is substantial money in in that way of doing it. There's a health savings account where if you're a family, you can get up to $8,000 into that. There are insurance plans that you can get some money into that you can ultimately make conversions. The point being here is there are ways of getting to that 0% tax rate. It comes down to planning. And this is an important point too. Sometimes around the cocktail hour or out on the golf course, you can use your imagination. You're out with these wealthy people, and you start having these conversations about advisory work and how it could be beneficial to them. What you'll get a lot of times is, hey, I was smart a couple decades ago. I got a bunch of Apple and Microsoft. I got Nvidia. Who needs an advisor? I'm a great stock picker myself. Stock picking is like very low on the totem pole of the valuable work that we do with our clientele. It's about asset protection and getting to lower tax rates. So I can say to that person, great, so you've got millions of dollars worth of Apple. How are you holding it? It turns out it's in a taxable brokerage account. So all they would have had to do those few decades ago, instead of, I mean, they could have done the same thing, pick the same stocks, but let's make sure we've set up a retirement account where your gains are going to be tax deferred. Let's backdoor it into a Roth where you're never going to pay taxes on it. Now, the same thing. We still got those millions of dollars worth of stock, but whereas they're sitting on a 40 or 50% tax liability, the guys who were able to put it into a Roth or an investment deferred vehicle, never going to pay taxes on it. And it's like, wouldn't you want that? But,
Right.
sometimes they're not having it.
This conversation kind of has the tone of when you sell, when you exit, when you sell off your property and you have this big capital gains. But there is a case to be made of ultra long-term planning and ultra
Mhm.
long-term succession planning where you don't pay capital gains because you just keep it in the family. You just keep the property in the family. You hold it in your trust. What about that?
Absolutely. This is one of the most valuable services we provide. Um, More people are getting to this point where they have a lot of assets and the complexity that comes with it starts to stump them. And it's like sort of like you graduate from your wealth advisor because your personal situation and your circumstances become so unique. They have these strategies like, okay, here's how we're going to invest and here's how we're going to do this. And it's not that different from you versus whoever else. Whereas, you've got real estate holdings, you're coming into an inheritance, your spouse is in a different industry, you split time between a couple different states, you have three children, a fourth is on the way. It's like, okay, now let's take a step back. We have enough money that we can start to think much longer term here. This is when we want to establish a family office. You can start putting assets into the family office. Your family members can be on the payroll of the family office where the income that you're generating, you can be paying back to your family, which is tax deductible. And this is going to make things clearer, neater, more organized. You're going to save on taxes, and you're setting yourself up that when it comes time to start these conversations about securing the generational wealth, transferring the generational wealth, leaving your estate and legacy intact, it's all baked in once you establish that family office. So this is something that we recommend. I try not to rage against the machine too much, but sometimes I'll be talking to someone and say like, "Hey, it's time to ditch your advisor. Like, let's start a family office here. You have exactly the type of case that we can solve all these issues for and get everything more optimized." So yes, I love that approach, and I think the family office is becoming a more popular way to achieve it.
I love it. So just to recap a little bit, we've talked about Roths, the backdoor Roth, talked about the SEP IRA, solo 401k, the HSA, and now this concept of the family office, all within, oh, and having smart people, all with under the
Of
umbrella
course.
of avoiding the tax man and paying as little, hopefully up to zero in capital gains. What else should be mentioned here as we round this out?
There is one honorable mention I like to throw in here because sometimes like that golf course conversation I'm imagining where you're trying to get through to someone and they're like, who needs it? I'm trying to get the valuation of this company to being worth 50 million. That's what I'm going to do. Why should I be worried about all this other complexity? Well, there's a story of Peter Thiel, who he's of one of these venture capital private equity guys. He was one of the founders for PayPal. And he's done plenty of other stuff since then. But the story with the PayPal is you could only put 2,000 into a Roth in those days, like mid 90s or so or thereabouts. He didn't have a controlling interest in PayPal, but he had some founder equity. He was able, they may have changed this rule. So I'm just telling the story. I'm not making any advice. He was able to buy a bunch of PayPal for, I believe, 1/1000th of a penny as his founder entry point, put it all into his Roth,
Wow.
made like, I don't know, a billion% return on it.
Right.
So Peter Thiel now is 57. He'll turn, when he's 59 and a half in 2.5 years, he'll have $5 billion in his Roth, all
Unbelievable.
tax free. So, if Peter Thiel could figure out a way to do it, it's just one of those things that's we can talk about structuring and trusts and this complexity, but something as simple as this, if you can get a really great entry on something, and even if you're a founder of it or if it's something that you have equity in it, if you can put it away into a Roth, just do that. Sometimes that's all you got to do. You sit on it, let it appreciate. So if it's good enough for someone like Peter Thiel, I'm sure everyone else could be benefiting from it too.
That's a great story, and that's a great way to round this out. So, if you're out there and you're considering capital gains, if you're wondering how this is going to affect you because maybe you have an event coming up, or if you're interested in succession or exit planning at any length, what is the call to action here?
I like to tell people to give me a call. We'll leave my number in the show notes. I'll say it for anyone who's listening who has a pen and paper ready. It's 310-947-4353. We'll leave my email too, but with this stuff, I think it's generally easier if you've got 5 minutes. If you're on your lunch break, just give me a call. Let's see if there's a few ideas that may make sense for you. If it makes sense to meet and go into greater detail, of course we can. But I'm in the business of giving out a lot of general advice because I like to help people and I know it can be confusing out there. So give me a call, please, anytime.
I love it. Now, this is a very meaty topic. We're going to continue to do more of these bite-sized conversations on the subject of capital gains. So, like, comment, subscribe, hit the notification bell, do what you must, get alerted, get notified for more of these high impact conversations. Thanks, Geoff.
Thank you, Tim.